All right. So today we are going to talk about the advantages of passive investing in apartment buildings. Of course, I'm Jason Yarusi, and today talking about passive real estate investing. And so passive real estate investing is a type of investment where you can put your money into a real estate asset, but you don't have to do any of the work involved in managing or operating the property. Instead, you hire a professional to do all of that. Here at Yarusi Holdings, we serve as that position, operating, finding, locating, underwriting, and professionally managing a number of different properties in 7 different states right now. And along with that, we have passive investors who join us along that journey. So here's our vision at Yarusi Holdings. We create cash flow through multifamily investments, ideally buying apartment buildings. We've done this back since 2016 with the aim of finding communities or finding apartment buildings that are just not serving the nature of providing great housing and looking to raise those communities. And along that mission, help others achieve their investment goals, others being passive investors who invest alongside of us. So again, here, as we go towards our mission, we provide solid passive investment opportunities. So there's many people out there who would love to have access to real estate, but they're busy in their hardworking life. And however, they can't find the time nor the need, nor the large down payment or the ability to have the available cash to buy the apartment building outright and have the time to actively manage this as they're busy in their full-time life. So we help busy, hardworking individuals to invest passively and hassle-free into producing risk-adjusted multifamily properties in the best emerging markets in the United States, predominantly the Southeast and the Midwest. And along with that, we create cash flow. Ideally, our properties here, we buy them, we maximize and optimize those properties to provide solid cash flow opportunities for our investors as they invest alongside with us. So some of the benefits of real estate and passive investing in real estate is there's less risk. Ideally, when you are putting your money into an apartment building, you're investing alongside a seasoned operator who's done this, whether or not on multiple different transactions. And so you're able to get the benefits of a real estate investment without having to put down the lion's shares of the capital, and also have the training ground of finding how to manage that property. You get more diversification. Unlike stocks and bonds, where you're typically in a stock or in a bond, and the ups and downs of that stock and bond, you're completely exposed to. Here with an apartment building, you potentially could have 50, 100, 200, 300 tenants who are, again, paying rent that will cover the expenses, cover the mortgage, and again, provide cash flow in the back end. And there's massive potential for high returns. Real estate on its own has outperformed multiple other asset classes, pretty much all other real estate asset classes, and stocks and bonds in a trailing 12-year average here. That said, you have the ability to benefit from real estate and multifamily real estate, from the cash flow, from the appreciation, from the tax advantages, the debt pay down, and the depreciation. And as a passive investor, you don't have to worry about managing or operating the property. So for our investors, on average, they invest $73,000, but we have investments where they can be in with as little as $25,000 or $50,000 and still get the benefits of investing passively in real estate by partaking in a syndication or one of our other investment opportunities. There's many reasons why investors choose to invest in apartment buildings. Some of the most common is its recurring rental income. Every month, on the month, the tenants pay their rent. The rent covers, of course, all of their exposure here for income, covers our expenses, covers our mortgage, and then past that, we have cash flow that gets passed along to investors. There's the appreciation potential. Apartment buildings have the inherent nature here where we can force forward the appreciation by making selected renovation packages to improve the property and improve the income streams of the property. So we may go in there, everything from improving curb appeal to improving signage to improving the landscaping to interior renovations, where we go and do select renovations inside the unit to match the market. And with matching the market there, it allows us to gain more income on the property by increasing the rent. We have the appreciation potential. The appreciation potential is also to the areas. We select great areas that have great path of progress in select communities here, in select neighborhoods, in trending states, predominantly in the Southeast. So over time, we also have the inherent nature where the actual area will appreciate as well, which benefits our building. There's the tax advantages and depreciation, where we're able to capture the depreciation benefits that come from real estate as well and pass those losses off, paper losses that can help offset some of the tax exposure that our investors have from their other active income that comes in. We have the leverage. One of the really big benefits of real estate is the ability to utilize leverage. When you buy a stock, it's basically $1 for one stock or $1,000 for $1,000 of stock. However, with multifamily investments, you may have anywhere from 60 to 70% of your investment covered by a loan that has a lower interest rate, where you can invest with less money down so you can potentially maximize your return profile for our passive investors. And then ideally, there's a diversification. You can diversify across different types of apartment buildings. You can diversify across different locations. You can also diversify across just having one large building where you're not exposed to maybe a flip house, or just a single rental property where you have one tenant, and if they do or don't pay your income stream, you're exposed, because then it comes back on you as the investor. So investing in apartment buildings can be a great way to generate income, build wealth, and diversify your portfolio here by using passive investing in apartment buildings. So now really, why multifamily? There's been 10 million new renter households in the past 10 years, and we're going to need an additional 16 million for this decade alone. That said, we're only on track to build 11 million homes, and that's going to continue to push the need that we need good affordable housing. With that coupled here, affordable housing is not being built each and every day. You're building new construction houses, which are typically outside the cost structure of what the average homeowner can get into today. Just over a year ago, if you could put down $1,500, you could potentially get yourself into maybe a $320,000 or $350,000 house. Today, that same rental payment with the increase in rates now has cut down your ability to buy a home by somewhere between 60 and 65% of the original purchase price you could get before. That said, home prices today have barely tapped off. Why? Because there's not enough housing. So people are forced to rent for longer, and they're going to stay for longer, and ideally push more revenue forward. So with that, we need 500,000 new rental houses per year through 2025. We haven't met the need for the number of rental units needed all the way back since 2009, just coming off the, we'll say, Great Recession here, of where people got burned and a lot of developers stopped building. Today, it's harder to build. Why is it harder to build? Well, costs more, harder with just all the regulatory need. And then with the inflation needs and interest rate needs, it's not the same capacity for developers want to come to the table, even though the need is there, because they can't make the same returns, but they're exposed to more of the risk. Couple that, you have average student loan debt grew by 6% year over year for the class of 2017, and that continues today. So you have people who can't afford a home, who ideally don't have the available cash, are constrained by some of their other expenses, so they're going to force to be renters for longer. So if you can find good affordable housing, you're always going to have a place in this market. There are a number of reasons why the commercial real estate market has performed so well for many years. Some of the most common reasons: strong economic growth. The U.S. economy has been growing steadily for many years, led to an increased demand for commercial real estate. Low interest rates, right? We've had a low interest rate environment. Even today with rates, prime is at 8.25%. Rates, although they've been elevated from where they have been in the past, they're still very low compared to what potentially our parents, our grandparents were used to just over 20, 30 years ago. Rising rents. With the increase in inflation here and the increase in property values, rents have continued to increase. So ideally, with the renters not being able to afford to get out in a home, it is pushing downward pressure on the available unit of rental units, and then putting upward trends into rents. And so if you're into a good area that has great housing, a limited supply, good path of progress, and numerous jobs, you're going to find you're going to have a high need for tenants who want to find good properties, and it's going to put a lot of pressure on rental rates, which we've seen in many of the markets that we invest in today. Increasing demand for the industrial space, the e-commerce boom has led to increased demand for industrial space, which has helped boost the value of industrial space. Well, why is that something of a good driver? Because it means more jobs are coming to the areas we invest in, which means more people are trending to want to live in these places, which again puts a lot of pressure on the demand for multifamily properties. The strong demand for housing has also led to the increased demand for multifamily properties, which has helped boost the need and value of apartment buildings as well. So what are the risks? Of course, there's the economic downturns, right? However, the word recession, we hear that a lot, right? We're coming up here, it's going to push us into recession. Ideally, recession is not a blanket term. So we do not see recession. If we do find ourselves in a recession, it does not happen countrywide. However, we invest in very strong markets that have a very strong backing to them. So we find that the recession, ideally, even if it comes, it's not going to really put a big damper on the markets we do. So everything from the Atlantas to the Nashvilles to the Louisvilles, anywhere in that form, you put yourself into the Floridas to Texas, you find a big driver because people are going to continue to come there because the jobs continue to come. The oversupply. Well, we've talked to this earlier. We need housing. Developers can't build housing fast enough or at a cheap enough number to want them to force forward. And even if they do want to build, the regulatory chain of command continues to limit the pace of which they can build. Lack of financing. There is the market exposure right now. We've seen a lot of bank collapses. So we are seeing the banking industry be very, of course, tricky at the moment. However, that comes and goes. We saw the same thing in COVID. There's a lot of uncertainty out there. So that trends to the banking industry. However, there are still banks lending. So we do have to make sure that we're having the right bank relationships. We're placing the right debt onto the properties. And regulations, a number of regulations that can apply to commercial real estate. This comes down from more of a state to state level. We really focus on states that are driven as landlord-friendly states. We do this because we do not want to be constrained by regulatory issues where a tenant-friendly state is driven where it potentially, if it was in New Jersey during a COVID, it may take 18 to 24 months to evict a tenant who was placed by a prior ownership that you're buying into. And so ideally, you want to be in states that you can control the narrative and not be driven by the force of the market. Number of different factors, including the drive strong multifamily property market, some of the most common factors. Strong demand for housing. We've seen that. You continue to see that here in the Nashville. You see this here in the Murfreesboro area. We see this driving into the Atlantas, over into the Carolinas. A strong demand for housing because people are coming there because of the growth in jobs, changing demographics. More people are choosing to rent rather than buy, most notably because they can't afford a home. So the different changes of people coming out of college, they're going to stay renters for longer. Parents or people who are now going into retirement age, they're going to choose to downside and move into a rental. Strong job market. We're in many markets here where the jobs are very strong. We speak to potentially even a Louisville, right? So you have so many different suppliers there of jobs that if any one closes up shop, it's not going to dampen the market because there's so many different reasons why people can come there and have a job. Increasing urbanization. More people are moving to urban areas, which has led to an increase in demand for multifamily properties in these areas. And those can be some of the most restrictive areas to build, which it puts a lot of pressure on rental rates and continues to push them forward. So as long as we see these factors stay in place, the multifamily property market is going to continue to remain strong. So we've talked a lot. Why multifamily? Why do we love it? It's the most secure sector of the U.S. real estate market. Easy access to debt. Even with this tricky environment, multifamily lenders want to lend on apartment buildings above all other. Their exposure rate and their limit of risk is spread out across multiple tenants. The leases on these compared to maybe an office building or a retail building where you have a 3 or 5 year lease are year-on-year leases. So you're able to adapt those leases year-on-year. Banks like lending to multifamily because they're more secure than a single family investment because that single family real estate investment is typically backed by the owner. If the property has income, great. If it does not, you have to make sure the owner has enough income to cover that mortgage. Where a multifamily property, you could have 20 tenants, 50 tenants, 2,000 tenants that could help pay down that mortgage, pay your expenses so the lender is less exposed. And the target properties are often institutionally owned and under management. So we find that even though it's large groups managing these, they may be a broad appeal of management and may not be into the fine-tuned nature of where we serve to make sure that these prices, getting back to our vision, are great communities and providing great housing for our community, which providing great housing helps to produce a better, attractive building, which trends to better returns, which trends to better cash flow for our investors. So if you want to learn about why multifamily, you can go to this QR here for a free why invest in multifamily. Make sure you go there. It's just a free download, put in your email, give you a good part. So you have something to take away from this today. Take a look at this, see about some of the other benefits that we talked to as we're covering a lot today. So real estate has historically outperformed stocks and bonds in terms of returns over the long run, 10.5% on average rolling from 1975 to 2021. However, the S&P 500, 9.8%. And that's really if you just have, we'll say, the bandwidth to stay in the market and not jump in and out. And the average bond market is 5.7% over that same time frame. So there's a number of reasons why real estate has outperformed stocks and bonds over the long term. And some of the most important, it serves as an inflation hedge. Lastly, there's a limited supply, right? Where stocks and bonds can continue to override and continue to issue more stocks. Real estate is either there or not. Demand, right? Real estate demand continues to remain strong, not only from here local, but also from abroad because of just the different components that you can utilize here in the US and the tax advantages. These tax benefits can help offset the cost of owning real estate and increase the return to investors. The government has learned a long time ago they are not good managers of real estate. So they have passed along a lot of tax benefits that can help push forward the ability for owners to want to own and provide housing for others. Real estate's not without risk. We did talk about this. So we talked about the lack of liquidity, right? You put your money in there to buy a building. This is not like a stock where you can go sell it tomorrow. So there is a limit of liquidity. However, that helps to produce a steadier investment where if there's something that comes out into the market where a stock or a company has some bad news come out, people can jump in and out of this stock very quickly, and it can ultimately hinder the value very quickly. Higher costs, right? Real estate can be an expensive investment, especially if you have to pay for the entire down payment, the closing costs, and all the construction costs. That's why acting as a passive investor with investments like here at University Holdings, you're able to get access to investment with very little money in. Volatility. Real estate prices can be volatile, which means they can go up and down in value over time. However, we look to find great properties in great markets, and with that, provide consistent cash flow that can be used throughout to help sustain in good times and bad. And we put on good debt on these properties where the good debt gives us the right timing to make good choices on the back end of how to exit this investment. And of course, there's the management headache. They're a labor-intensive process, so you need to manage the property, find tenants, deal with the repairs and maintenance. However, here at University Holdings, we have a built-out infrastructure. We handle all the headaches, so you as an investor can simply invest, get the benefits of real estate without all the headaches. Multifamily consistently, we talked about providing higher returns compared to other methods. If you looked, it's outperformed office, hotels, and retail, and specifically office today. This is trending about it in 2 years, going back to 2017. If you look at where office is sunk to today, it provides very strong returns compared to all other asset classes. Key apartment factors, long track record of having the highest risk-adjusted returns, proven to be resilient in economic downturn. There's cash distribution where you have low capital expenditures and technical improvements. Lower cost of capital, we talked about, compared to potentially stocks and bonds and others, because you're able to invest alongside leveraging it with the proper loan on the building. Shorter leases, we talked to this earlier, you have year-on-year leases. You can adapt to any market on each of these 12 years, and leases are typically aspiring throughout the year. So you're able to adapt to change in the market, whether the market is up or down, compared to a market where you have office or retail where you're stuck into a 3, 5, sometimes 10-year lease. And rental housing needs expected to expand while supply subsides. We talked a lot earlier, you cannot keep up with the building. It's going to continue to put downward pressure onto apartment communities. So a limited partner can benefit from the passive investing in multifamily properties in a number of ways. You have passive income. You also partake in the profit of the property. So past the initial returns, if the property does well, you get a share of future investments as well, including the profit on the back end. You get diversification. You're able to access an investment where you do not have to just buy the investment outright and have all your exposure. You're able to access potentially one investment or multiple investments where you can partake in the benefits of real estate without having to have the headaches of managing real estate or have all of your funds into one different opportunity. And depending on how you invest, you can also benefit from the tax benefits that come from real estate as a K1 is offered, and the offset of anything that can offset your exposure is passed through to K1. So we use a thing called syndication. This is where the general partners, who is my team, we act as the operating partners on the property, and the limited partners, which partake all of the passive investors into that opportunity. Along with that, we form an LLC, and that LLC buys the property. The LLC on itself is a single asset entity where that LLC itself is only buying this one apartment building or this one community. Within there, there's going to be the general partners. We will be the Class B members and the limited partners as the Class A members, and we will form to buy this. We pair buying this building with debt, and we use that to maximize the returns. The equity being raised is for the down payment, the capital expenditures, and any other items that we will detail out in the paperwork we provide to our passive investors so they can understand the investments. The paperwork we provide is a private placement agreement, an operating agreement, and a subscription agreement. This details out all the risks, all the rewards, everything we've talked to the nature of just multifamily investing, along with the specific nature of this deal, why we're investing in it, what kind of returns are expected from this building, how much capital we're raising, the cost of the building overall. And it will detail this out for the investor so they can make an educated decision about how to invest and whether or not this is the right opportunity for them. Real estate syndication is an effective way for investors to pool their financial and intellectual resources to invest in properties much bigger than they can afford or manage on their own. So you can buy larger properties than an individual entity could do on its own, and then buy more properties than an individual entity could buy on their own. So if you were an investor, maybe you could buy a 4-unit or maybe a 10-unit or maybe even a 20-unit building. However, that may have all of your disposable income for now into that apartment community. However, investing in a syndication, you may be able to invest in multiple opportunities, hundreds or thousands of units here, and get the exposure to diversification of multiple properties. We have 2 different investor sets that are able to invest in our properties based on the offering. There are sophisticated investors. Those are investors deemed to have sophisticated investing experience and a knowledge to weigh risks and merits of investment opportunities. We also have accredited investors. Accredited investors is one who either has a net worth of $1 million, not including the primary home, or has made $200,000 as a single person or $300,000 as a married couple in the last 2 years. So, quick note, real estate is our security. Passive investments can give you more protection, security, and freedom than you can find in many different asset classes, and also doing this on your own. The investment structure, this is how it looks. So we have Urusi Holdings and investors side by side. We handle on the asset management, basically all of the operations of the property itself. We create a US LLC. That LLC is the buying entity for the property that will purchase the multifamily real estate, which will pair with non-recourse or selected debt to buy this property alongside of our LLC. Overview of our roles. Investors, they handle the down payment. We'll handle the earnest money typically, but the down payment, the fees, the CapEx or construction budget, and any of the cash reserves will come in from the investors. Urusi Holdings, we find the deals. We review deals and determine which ones to make offer on. We make and negotiate offers. We coordinate with professional property inspectors. We find the best financing options for properties. We pay attorney fees. We perform the due diligence on a property. We hire and oversee property management companies, and we perform the asset management duties, including the overall repositioning and the day-to-day operation of the asset. And we're responsible for signing in the loan. Combined, as investors alongside Urusi Holdings, we review the numbers of a property after offer is accepted, but before earnest money is sent. We review and sign the LLC agreement or any of the other operating documents as part taking for becoming part of this operation. So what we try to do is we take the lion's share of the work off the investor's table so they can solely look at whether or not this investment fits their investment criteria and whether or not this will make a good piece of the puzzle for their investment platform going forward. How do investors make money? They're offered a preferred return. What this is that this is not a guarantee of returns, but they are paid returns, paid out quarterly, of the first returns that come out of the property, typically anywhere between 7 and 10%. And then they have equity inside the deal, and the upside potential is based on the percentage of ownership. So a typical split is that the syndicators or operators, ourselves or Urusi Holdings, we will have 30% ownership and the investors will have 70%. So after that preferred return is paid out, any of the promote will be split out, or any of the additional cash flow profit will be split out 30% to our team and 70% to their team. However, we will not get a split until the preferred return is met. So it allows investors to have like-kind interests with us as we see side by side that the investment itself is going to have a return for our investors, and we have to perform before there's any split for us as the operators. Our approach is we provide clean, efficient living conditions for retail and blue-collar workers, ultimately improve the quality of life for those customers. We build long-term residents that result in high occupancies for the properties, renovate any deferred maintenance, create desirable living conditions, and implement a professional management team with a focus on customer service. So here could be an example of a typical deal. So if you have a sample 100% investment here, profits after original principal return, you have the investor who would invest $100,000 at closing. In year one, their preferred return, they may get 6.2%. And then in year two, all the way followed, 7.8%, 8%, 9.2%, and 9.8%. In this year one, this is a 7% preferred return opportunity. If they only receive 6.2%, the other 0.8% will accrue to following years until it's paid off. And that will accrue, meaning that there will be no split to our team until we meet the accrued preferred return. So past that, you'll have cash flow proceeds of $41,000, sale proceeds $49,500. So return of principal, $100,000, total profits on top of that would be $90,500. So typically from that fact, this means that for every dollar that the investor invests, they will get back over 1.9x that investment dollar. Deal criteria. So our target metrics, we really look for properties about 100 units. We look for loans where the loan to value coming from the lender is anywhere between 70 to 75%. Annual returns greater than 8%, not including the return. An average annual return target, and the annualized return, this includes the profit from sale of on average 15%. And our hold period, meaning that we buy these properties, that we don't hold them forever. We typically hold them for 5 to 10 years. So on the right side, again, you can look at a sample $100,000 investment trending on this use case where we would have 8.2% cash on cash, equity multiple of 1.9%, a 17% average annual return, including the profit for sale, and a 14.6 IRR. So where do investors access investing capital? Well, for us, we go out to a large series of our friends, our family, our retail investors, and just our network from friends and family. So that includes inner circle networks and coworkers. As talked about, we get loans from banks, from non-bank lenders, hard money lenders, IRA and retirement money come in as investing capital as well. We have loans that can come from life insurance. Our investors may pull from personal savings, or they may pull from a line of credit, or may come from cash or active income. And then we may pair with private equity or hedge funds or lines of credit. So there's multiple access for capital. Our typical investment has friends and family or our inner circle who invest either with active income they are making from their current day-to-day activities, or with income that they have or money they have from savings or IRA money. And we pair that with a bank that will lend us the other 65 to 70, 75% of the money. Our strategy is we focus here. Oh, jumped on me here. Is we focus on employment drivers for markets, GDP growth, multifamily rental trends, supply constraints, markets where we are not seeing an oversupply of building happening. So we're going to continue to see a need and high occupancies across our properties, multifamily cap trends in order to achieve our 8% annual returns without the profit from the sale. The economics of the market have to continue to remain strong. So we want path of progress, lots of jobs, diversity in jobs, and lots of people coming there. Our 7-step process is we buy a property, we reposition that property from the outside in, we increase occupancy at market rate, meaning that we charge rental rates that are matching the market. We implement either a build back or a rub system where we pass off some of the utility exposure back to the tenants. As leases renew, we will raise those remaining rents. We will then either refinance, and at that point, potentially return some of the capital to investors, and they will stay as part of the deal, or sell the property and then duplicate the process. This has been a tried and true process that across we've done now 13 times. We continue to do today as we actively manage these properties. Our analysis, we may focus on 100 deals, get down to 30 of them that we really want to take a harder look at, offer maybe on 10 of those deals to get to one acquisition. So we do a lot of back-end work here at University Holdings to make sure we're finding the right opportunities for our investors to partake in. How does this work? When an investor is interested in an opportunity, they can come to our portal, which is at yh.investnext.com. At that portal, they can fill out an investor form. They will get news and information both on some of the education materials we put out, including also the ability to see offerings as they come out. They're welcome to schedule a call so we can learn more about them and their investing criteria, what they are seeking, and just overall see how we can potentially benefit them with the passive investments we offer. When they find an offering that fits their investment needs, we will complete paperwork and send them paperwork to them, who they can fill out and finalize their paperwork. And then they can now be part of a deal that they can sit back and relax and partake in the benefits of real estate that we talked to earlier. Here's a case study. And for time, I won't jump through all of these, but 94-unit apartment building, this is one we sold. We were able to implement a reduced purchase price by negotiating back with the owners. So instead of a $3.2 million purchase price, we're able to get this for $2.3 million purchase price. Issues with the property before acquisition was that they had not renovated units. There was high vacancy on the property. They were not seeking to reach out to do the renovations to meet market rents. Over here, we went in and implemented a try and true process by renovating the units, filling the units. And after a year, we were able to refinance this property and pull out 75% of the investor's money and give it back to them. We continue to increase rents to market, meaning to meet market, which is the available buildings after that. We implemented a build back or a water savings program, which saved us 31% on our utility bill. And after just over, we'll say 30 months, we're able to sell this property and have a massive return for our investors. Another case study, we use similar use case, creative financing. We implemented a number of issues with just the same business plan, finding underperforming assets, improving the nature of the building, improving the overall community itself, raising rents, filling units, pairing this with great debt, rebranding the building, and then providing cash flow for our investors, ultimately to now sell the property just over 13 months later. This one was right next door. We modeled after the side-by-side building. We branded these buildings together in Preston 1 and Preston 2. Same thing. We stabilized the tenant base, made these places better places to live, did select renovations inside these units, increased the rents to market. And after just originally 47 units, we converted the office into an additional unit, moved the office into a neighboring building that was just used as the laundry, and then sold this one 25 months later by just implementing these try and true strategies. This 32 unit, same thing. We were able to go in there and just maximize on the townhome feel of this building. There was interior and exterior deferred maintenance, meaning that they had not been touched by the prior ownership in a number of years. So we came in there, did select renovations, LVP flooring, new paint for basically walls and trim, change out the cabinets, change out the countertops, improved just the overall light fixtures across that point. We're able to bring the rents up considerably to match the market. We were able to make green repairs that worked with our loan to cut down our energy bill 15%, cut down our water bill 20%. So it saved us on the back end here of income. We reduced our management costs by streamlining repairs quickly after purchase, continued to increase rents to market on turns, and renovated 25 of the 32 units before selling this property. This one alone, we did sell this recently too. It was the same model. So as you can see here, we find at Urrusi Holdings like-kind properties where our business plan has been tried and true to implement this plan continually to go in there and make these better places to live just to fit our mission and fit our vision. 902 is 93 units. This property was known as the property anybody could come rent at. They were serving the nature for weekly rentals. They did not have any criteria for rental nature. So we went in there and did a select renovation package across all the units, very streamlined, all 2-bedroom units. We completely increased the curb appeal of this building by doing a complete paint job across this building. It was one great building, gave a nice 2-tone, 3-tone colored package to this building. So it really stood out, changed the siding, changed the overall nature of this building. So tenants who are coming here now, they have a whole different perspective of what this building can and how this can offer. And you went from a place that had a very bad tenant profile to one that's considerably better today. Bunch of kids running around, and really serves to build the community and make this a better place overall for the community. This property itself, great property. We were able to go in there and negotiate a great deal on this property. We found that we were able to take advantage of some of the lack of knowledge of the brokers who were selling this building and the owners, as they were marketing this property as if it was a decade older than it was actually was. So we went to tax card, discovered it was a 1988 building. They were actually marketing this as a 1978 building. They were honestly marketing this building that the units were 100 square feet smaller than they actually were. So using our knowledge, we were to go in there and take advantage of that interior, knowledge that we had learned to get a great price on this building. We increased rents from $895 up to $1,195. We renovated 30 of the 48 units in the first 7 months of ownership. We're able to completely streamline the process for tenants to be able to pay through a portal. And we sold this building 30 months after the acquisition of this building. Another one here, 24 units here in Murfreesboro, Tennessee. Very same thing. The owner who had owned the building since it was built. They had had this building from the time all the way through. They had not done a renovation package inside the units. They were just letting the building basically run itself. We went in there and implemented a very professional management play with this building, put through our mission vision process, completely change out everything from just the feel of the property, the nature of the property, and just let tenants know that we were here to make this better. This property performed very well, and we sold this property after 13 months of ownership. And you want to save this presentation for later, feel free to scan this QR code for a free download of this presentation. Really appreciate you jumping on today and taking in part here. I know, Andrew, I think you were our sole one. So thank you so much for
I know. I'm
so
surprised nobody else jumped
hanging in there. You know what it is,
yeah,
but
yeah.
we've had whatever. But this is fantastic. And we'll actually get this sharing out there, but at least I'll use it as recording, make sure I can get it out to the rest of the team and the rest of the network as well. So
yeah, definitely. It was definitely interesting. So
well, good. I hope I was able to add a little value in your day there. And I appreciate you jumping on, and feel free to let me know any other questions. We'll do another one of these in a couple of weeks as well.
Okay, sounds good. Thank you.
Awesome. Thank you. Talk to you in a bit.
All right. Bye.